Now, this chapter I found interesting. Again, I don't know if you find certain things about the auditing class interesting, but this one I think is, because it tells you a lot about the profession you're going into and what the pitfalls are from a legal liability standpoint. The last chapter we did, again, talked about independence and a lot of the other things that you can trip over as an auditor and things you have to be wary of. But this is sort of this whole chapter talks about, who can come after us and why they can come after us, how they come after us in the different arenas. And I didn't know all of this stuff till I sort of read the book. I mean, I knew some of it. But I think anybody who's been in public accounting for any period of time will at some point in time run into problems with legal liability. It's just, our society is extremely litigious, and I doubt you'll find any firm of any substance that hasn't had a legal problem of some sort in front of anybody. The fact of the matter is, when something goes wrong, if something financially that accountants are involved in, the world has a tendency to blame us, or to think we're partially responsible for the problem. As I told you, while this chapter deals almost exclusively with responsibility for attest services, for audits mainly, audits are actually not even the number one culprit. Taxes are when we meet with our insurance people every year, which is a requirement of our malpractice insurance to go over what's going on in the world of liability. Tax usually wins out in terms of the amount of cases that are brought. Then again, there's a lot more tax work actually done in this country than the number of audits that are done. So we're going to talk here about legal liabilities. Where does it stem from? What are the ramifications? What are the laws involved here? And why does it happen? How we're going to avoid it. We as a profession actually are much more susceptible to litigation and the number of people who come after us than other professions. When you think about a doctor, if a doctor screws up, because obviously it's a serious problem, he screws up with a patient and one person comes after him. Patient to the patient's family is going to come after him. So when there's a problem, it's individualized to that particular patient. If something goes wrong with what an accountant does, or there's a belief that there's something goes wrong with something that an accountant does, the number of parties who may suffer as a result of it can number in the thousands, could number potentially higher than that. Let's look at a company that, there's thousands and thousands of stockholders. All of a sudden the company goes bankrupt out of nowhere. People look at the financial statements and say, where were the accountants? Why were the accountants? What did they do right? What did they do wrong? Well, how many potential litigants are there? Well, you got millions of investors out there. You've got banks, you've got creditors, you've got a host of people who come after an accountant in the event that there's a bad financial statement. You look in the public arena, look at any particular company. You know how many people probably would have sued in the Enron case or the WorldCom case had there been actually something to go after? So you look there, so the amount of investors and creditors are huge. So our potential for being attacked based upon what we do is so much larger than a lot of other industries where you look for liability. Some cases, the numbers can be staggering. You look at a company, when we look at a company for potential in terms of auditing a company, and we look at risk, we look at things like market capitalization. Does everybody know what market capitalization is? Market capitalization is a very easy formula. Take a public company, you get the number of shares that they're outstanding, multiply it by the price per share, that's their market capitalization. If you look at some numbers in there, humongous. So you look at a company, then they have market capitalizations of billions and billions of dollars. And some of these, you look at Apple today, what their market cap is, I think it just set a record. It's a number that, it's like the gross national product. So you look at what your risk is, and that's your potential risk. Those investors have put money into the company. They lose it, they're going after what they lost. So the amount of money that's out there is extreme, and in some cases it absolutely exceeds the limits of the professional liability insurance that you can buy. Professional liability insurance, I think, is our second largest or third largest expense in an accounting firm. I think in ours, after payroll and rent, I think it was next. The cost of getting professional liability insurance. And it varies depending on the marketplace, how available it is, and where you have to go to get it, how expensive it is in any particular point in time. It is an extremely high cost in an accounting firm, and everybody has it. You cannot possibly operate as an accounting firm without having some type of liability insurance. As a matter of fact, it happens to be a question potential clients ask you. You might say, well, there's a funny question. It's like asking, like, how much you have in case I come after you? But they want to know. They want to know, are you covered? In the event there's a problem, you have insurance, guys? So, the scope of CPA liability is humongous. Where does it come from? Okay? Usually, when we're talking audits, that's what we're going to talk about mainly here. It's from an inadequate audit. Something went wrong in an audit of some sort. Okay? Could be the numbers wrong, or the estimates wrong. Did you get the wrong reserves? And a lot of the, accounting, a lot of it's hindsight at this point in time. You see numbers, a year later, you put a reserve on the inside, and you find it's completely off base, and you did the best, but you thought you did the best at the time, and found out later on, geez, that reserve is horrible. People come after you. Why didn't you do a better job? Why didn't you know better? Why didn't you, use a different approach? Other times, what happens? Why do people come after accountants? Words at the end, deep pockets. People know that accounting firms are relatively well-capitalized organizations normally, so there's money to be had, and all clients are aware the amount of insurance that you have. They know in the event of a problem, you're able to go after the accounts. Look at it. You invest in a company. You think it's a good company. All of a sudden, you get something in the mail, you're reading paper, the company went bankrupt. Your investment just went down the tubes. You think you've been misled. You think you got bad information. Well, you want to sue the company, sue the financials. But remember what I said, they're bankrupt. So where am I going? Who am I attacking? Well, there's the accountants. They're always the ones with the money. They're still in business. They were involved in the financials. They must have some culpability. They're the ones, quote unquote, with the deep pockets. Where does our liability stem from as accountants? Two areas. One called common law, the other called statutory liability. We're going to talk about both. Common law is developed through case decisions, and we're going to talk about a bunch of case decisions over the years. Things that went to court and determined what the accountant's liability was, what their fault was, what they were responsible for. And the three areas where that comes from, case decisions stem from, three particular areas. One, breach of contract. When we are hired by a client, there's a contract. It's called an engagement letter. We require it on everything we do today. And we've gotten a lot stricter. We do a tax return for a client. We require an engagement letter. Spells out clearly what our responsibilities are, what the client's responsibilities are. Be honest, it gives you what escape clauses there are, when we can stop doing work, what responsibilities for paying are, how to settle disputes, where to settle disputes. Engagement letters, I don't know if you've seen one yet. They're extremely long today. They used to be like 2 pages. They're like 20 pages today. They're look like they come right out. They come from lawyers. They absolutely do. But they absolutely spell out the contract between the accounting firm and the client. And we require them to be signed before we start work. And like I said, we won't even do your tax return today without an engagement letter on the tax return. So sometimes it comes from breach of contract. Most of the time it comes from some form of negligence. Something went wrong in the numbers, and the belief is the accountant did a bad job in the audit. Okay? And other times it arises due to fraud. Okay? So and we're going to talk about the cases. Now, when we talk about the cases and the different ways that it's settled, understand something with law. Every law is different in different states. Different states handle accounting matters differently of different laws concerning what accounting liability is. We're going to talk when we get to certain things about what New Jersey's is today. It's one of the reasons, for example, when we sign with a client, we require arbitration. We have an arbitration clause in our engagement letters, and we require it under the state laws of New York. We put it in there right in the letter. There's reasons, and I don't even know them because I'm not a lawyer, that we find that the laws in New York are easier in certain regards than in New Jersey. So clients agreed, if they read them carefully, but they have agreed that we're going to arbitrate things and we're going to do it under New York law. Statutory liabilities, which were governmental laws. A lot of this is the SEC. We're talking about some of the SEC laws here. Securities Act of 33, 34, RICO, which is the Racketeering Act. These are statutory things, government laws, which also place certain liabilities upon us. So it's either in the common law and cases that have occurred in a variety of states. Like I said, it varies state to state. And according to what our responsibilities are, or certain statutes which, mainly federal statutes that we need to comply with. Primary sources of CPA liability, where do they come from? Breach of contract. How do we breach a contract? These examples. We put in our engagement letter, the client requires it. I need to do it done by the end of March. I need to have my financial statements done by the end of March. We put our engagement letter together. You get us your information by the beginning of February. We'll issue an audit report by the end of March, assuming we have everything in our hands. We get everything in our hands, and for whatever reason we don't get it out by the end of March, the client winds up in breach of some type of a contract or some type of an agreement with the bank. The bank calls the loan, and all of a sudden, whose fault is it? It was ours. We breached the contract. We agreed to do it by the end of March. We didn't get it done by the end of March. We agreed to do other things in our engagement letter, and we don't do them, then we breached the contract. But our contracts are pretty good usually in this regard. And like I said, we normally have certain escape clauses. For example, once a client signs an engagement letter, are we required to finish an audit? No. The client doesn't do what they're supposed to do within the time period that they're supposed to, or we find the records unauditable. We always have an escape clause in which says, hey, listen, we've agreed to do an audit, but if we come in here and find out we can't do the audit because you don't have the records that you said you can have, we have the right to withdraw, and we have the right to be paid for our work up to that date. So there's always things in there, of course, to protect both sides. Accountants always are going to do everything they can to protect themselves and themselves. But sometimes we can breach contracts easily and be sued for it. Negligence. We're going to talk about two terms, negligence and gross negligence. Ordinary negligence. Sort of like doing a bad job versus doing a horrible job, okay? But what is negligence? It's a violation of your legal duty, your due diligence, to exercise a degree of care that an ordinary, prudent person would exercise under certain circumstances. So what people are going to look for is, hey, you didn't do a good job here. A good auditor would have done this. A good auditor would have done these things. Generally accepted accounting standards require you to do this, this, and this. You didn't do them. You didn't apply certain principles of sampling correctly. You did a sample. You found violations. You found mistakes in your sample. We haven't talked about sampling as one of our audit techniques now, but we will during the semester. And when we go in and look at a population that has 10,000 items in it, and sampling tells you if you look at 60 and they're okay, you're done with the sample, and everything's fine. But you take that sample and you find 5 errors in there, and if you said, okay, and found 5 errors, that's not that bad, you move on. There's a problem later on. Well, you didn't get audit. That's how sampling teaches you in terms of how to audit. You take a small sample and find problems, you've got to expand your audit techniques. There's an area. Other thing, there's a million and one things, and we'll talk about them. They're an ordinary care that a good auditor will learn to do. And if you don't do and the problem comes up later, you're subject to tort violation of negligence. Gross negligence is when you do a really lousy job. Okay? It's a matter of judgment. When somebody would look and say, didn't even show the slightest care, it was reckless disregard for your responsibilities. Give me an example, Professor. I go in and I just audited Bank of America, and my work paper file was this big. I've seen work paper files that big. You'd be amazed. You go in and somebody looks and says, I looked at Bank of America and I audited their loans payable account, and I looked at 3 loans. 3 loans are okay, and it tied into the general ledger. Perfect. That's pretty gross negligence, okay? So, I mean, it's an extreme, but when people can go in and do that, you're subject to a lot more liability than if it's just what they call ordinary negligence. And it actually comes up in some of the cases, whether or not it's judged to be ordinary or gross negligence. Fraud, we know what that is, but again, misrepresentation by a person of a material fact. When you know it to be untrue, or you make it with reckless indifference whether the fact is true or not, you just throw a number out there, okay? You don't care whether it's right or wrong. And then there's a term called constructive fraud. That's how you're not really intending to do it, but the numbers are really misrepresented. But we know what fraud is. When you intentionally put bad numbers out there. Does it happen? Yeah, it does. It's been known to happen. Then we get to, again, the statutory. We're going to talk about these. Again, post-1929. Again, most of you probably heard about the stock market crash in 1929. After that, the U.S. government realized that we needed to control the public markets. There had been particularly nobody controlling public markets. All of a sudden, we had this tremendous crash in the stock market. People were jumping off buildings. Terrible things happened. We went into the Great Depression of the 1930s. Shortly thereafter, and 2 things were created. The Securities and Exchange Commission was created, and 2 Securities Acts were passed in 1933 and 1934. They still exist today, and we're going to talk about what they do. And we're talking here with these about public securities. These don't involve private companies, but they're extremely material as it involves responsibilities of public companies and auditors for public companies. There's some criminal statutes. You can violate certain securities acts and face criminal liability. You can go to jail as an accountant for doing certain things. It has happened. And under certain statutes, you're subject to what, again, I think you all know what the term is, a class action lawsuit. Yes.
I have a question from the previous slide regarding fraud.
Yeah.
So, like, I read that, mistakes happen, and worst case scenario, like, plugging, you say, alright, that only broke this number instead of that number. So what happens if it really is fraud, and they say it's a mistake? How do you...
So I'm not following you. What happens if...
What happens if I wrote 1,010,000 instead of 910,000? And
it turned out to be something that somebody sued them for. That wouldn't be fraud. I mean, that might come under negligence. Fraud is when you actually, I go into a client that's losing money, okay? Client says, if I lose money, if I show a loss, okay, this year, my bank loan requires me to show profit, okay? If I show a loss on my financial statements, my bank has the right to pull my loan, okay? I can't show a loss. I look at the numbers and have loss. Mine says, I can't have a loss. Okay, let's make a couple journal entries, let's make it profit. Let's debit receivables, credit revenue. Let's just pick up some receivables. Let's not accrue some expenses that we need to, okay? Let's not do this, let's do that, let's value inventory a little bit. And all of a sudden, a loss turns into a profit. That's fraud. That's fraud. I make a mistake in the number. That's what I make a mistake in, whether it's actually negligence or not. Okay? I don't know if that's answering your question.
Well, what I think what I'm unsure about is what happens if you can, if perhaps like, if the account says that it was negligence, but really it was fraud, how do you prove that or you can't?
Can you prove fraud? Yeah, you can prove fraud by intent. Do some asking questions and find out why things happen. But in this case, let's go back to my case. I made a loss of the profit. Mr. Cohen, I see this journal entry. Debit accounts receivable, credit revenue. Could you explain the backup to that entry? Could you show me the backup to what you did? Could you show me the audit techniques that you used to get that? Could you show me the documentation behind that? I don't have any documentation. Well, that's what I'm saying, my mind went blank today just to try to pick up some revenue. It's not hard. Once you start asking questions, looking, what do they do when a case gets, you get sued? The first thing we do in our case, we lock down everything. We lock down the work papers instantly. That's it. Because the last thing in the world you need is to show you changed anything if you get sued. It goes on immediately lock down everybody's phone. Don't delete an email. Don't do anything. Don't talk to anybody. Don't do anything. There's a lawsuit. Okay. Immediately the work papers are pulled. Okay. And we start examining them ourselves. We start doing a self-inspection. You don't change anything because if you change anything, anybody knows today what they did. So things get pulled, things get examined, the lawyers jump right in. We start doing our own self-examination in the case of a problem. Just to see, do we have the audit documentation we need? We start interviewing the auditors. I don't know what happened. Yes.
In your case, not the client, if the bank is going to be.
We're going to get the food suing you. It makes a big difference. We're going to find there's basically two types of lawsuits. Is your client suing you, or is a third party suing you? And there's a distinct difference in the law and who's allowed to sue you. Your client, we're going to talk about why a client can sue you. What are the 4 conditions they need to sue you? What are the 4 conditions they need to prove to be able to win a lawsuit? In the United States of America, you can sue anybody for anything. Okay? I mean, so how many frivolous lawsuits are filed all the time? Sometimes people win. I never understood the McDonald's coffee. McDonald's gets sued by a woman. Steph, off. I'm on a off. Okay. This is like 5 years ago. A woman gets a cup of coffee at McDonald's in the drive. She drives away and spills the coffee on herself. Burns herself with the hot scalding coffee and sues McDonald's for not warning her that the coffee was that hot. Won the lawsuit. You pick up a McDonald's cup today, does it not say something? There's a warning on the cup that says this coffee, is there one on there? What does it say?
Extremely hot. This beverage is extremely hot.
That's what Dunkin' Donuts. That was in response to the McDonald's lawsuit where this woman sued them because she spilled hot coffee on herself and put it down. And won. Astonishing. Are you kidding me? I wouldn't have even thought to sue somebody. I'd be too embarrassed I spilled the coffee on myself. But she won the case. She won. God bless America. Okay, so class action again, we got off here by investors. Usually when there's a problem, the investors get together and it's called class action. They all sue you together. We're going to talk very little about the RICO Act, Racketeer Influence Corruption Organizations Act. This was actually designed to go after organized crime, but there's some statutes in there that sort of pulled in what an accountant could do. But most of that, if you read the book, has been overwritten, and you rarely ever see RICO cases and accountants together. So again, let's read the words here. Elements of proof by a client of the law. This is the question here. We're talking about, not talking about third parties. We're not talking about the bank suing you now. We're talking about the client themselves suing you under common law. You do something that causes them, you issue a bad financial statement. There's 4 things they need to be able to do to actually get you under this. 1, did you perform under, you have to prove that you didn't perform under due professional care. You didn't do things the proper way. They've got to be able to prove that. They've got to prove that you breached that, okay? That you accepted a job to do it the right way, and you breached that duty. You didn't do a good audit. You didn't do the steps you were supposed to do. You didn't do the disclosures you were required to under GAAP. Here's an important one. People who cited somebody, when you talk about they're going to sue somebody. You actually have to have a loss. You have to have a loss. The company goes out of business because they had a bad business. They had to lose as a result. There had to be a suffering by the plaintiff, okay? That they can pin on you, okay? That's the 4th thing. Causation. The losses were caused by the CPA. Okay, they lost money. The bank foreclosed on their loan. You did a bad audit. You got the numbers wrong. But if it wasn't, they were going to foreclose on the loan anyway. They can't blame you for the fact that the bank closed them down. And there's got to be losses. In other words, they can't come after you. You do a lousy audit. You come up with the wrong numbers. Okay? Or you don't find, you come up with the wrong numbers. But tomorrow is the same as today. The company goes on, they're in business now. You got your own financials. You got a bad balance, you got a bad income statement. Nothing happened to the government. They didn't lose any money. They just kept going on. They can't sue you for a bad audit. They didn't have a loss. And then they got to prove that there was no loss, that this bad audit caused them to lose some money, and then they got to, whatever this loss was, they got to pin it back on you and say, okay, you did a bad audit, I lost money, and if the fact that I lost money is because of the bad audit. If it's for some other reason other than your bad audit, well, again, they can't get you for that. They look at it and go, it wasn't, yeah, the CPA did a lousy job, but your losses were because of you, or some other reason, not because of the account. So, and like I said, number 3 is very important. I get the numbers completely wrong, but if there was no loss suffered by the client, they don't have a cause of action. They don't have a loss to sue for. But all they can do in that case is usually say, you know, I'm not paying fees. I'm firing you and getting you an account. They can't sue you for a bad audit if they didn't lose money as a result of it. And if they had a loss, if it wasn't your fault, then it's not on you. So how do we talk about elements of duty and breach of duty? Or elements of duty are defined under generally accepted auditing standards. And they're always defined again in our engagement letter and any legal considerations when we take on jobs. We're very careful with that these days. All accounting firms are. Engagement letters must. Following gas must. Anything legal to do with clients must. After 2008, when the economy went to 10, companies started going bust. People were going after everybody, more bad people than I'd ever seen before. People start going after people. And what you couldn't do in business so far, you go after someone, see if you win a lawsuit. Accounting firms just got a lot more careful. The new companies were in trouble. There was more risk of things going wrong, more risk of people doing bad things to keep going. So everybody got a lot more careful with things and a lot tightened up, I think, a lot. So what's the breach of our duty that's required under these? Well, we didn't do the obligation listed in the engagement letter. Again, we keep repeating that engagement letter, how important it is. That is the Bible by which the contract with us between the client. This is what we're going to do. This is what we're going to charge. This is what you're going to do. These are the dates. And if something goes wrong, this is how we're going to solve it. We don't meet professional standards. We don't do our audits in accordance with GAS. We don't do what we should have done to document our papers, to do what we needed. What auditor's supposed to do, we've got to breach a duty. And it doesn't imply if there's a misstatement to errors or fraud that necessarily you did a bad job. We're talking about circumstances where it's not your fault. People, there's collusion. The largest fraud I've ever seen, there were 4 people at the client's office that colluded, I think that's the right word, the owner and 3 people in the accounting department that make it virtually impossible for an accountant to find fraud when everybody's getting together to trick you in effect. So sometimes it's not your fault that something goes wrong. So it doesn't imply you're negligent because numbers are bad, when there's a misstatement or a fraud, doesn't mean the accountant's at fault. Remember, we can't do everything. We don't look at every transaction. We don't look at every account. If you did, you'd never stop working. Think about large companies, zillions of transactions. So if it didn't fall into a sample, something that went wrong, well, you can't, if you did your job properly, this thing fell outside the sample, you were just unlucky. But that doesn't mean you did a bad job, and that doesn't mean you're going to be held liable in a court. So again, for a loss and causation, let's go into that losses. There's got to be damage to the plaintiff. Okay? They've got to have lost money as a result. They can't just say you got bad numbers, we're suing you. And again, what are the defenses against causation? Is it your fault? Yeah, you're negligent in your audit, but that's not what caused you to lose money. Very important terms. Contributory negligence and comparative negligence. What is contributory negligence? That means, hey, listen, the audit went bad. The accountants are responsible some, management's responsible for some. There's bad numbers there, but a whole bunch of people were involved in it. Maybe it's not all the accountant's fault. Okay? Comparative negligence. How much is yours? How much is this is case law in a lot of places. At the end they say, okay, the investors lost X dollars. We think X percent of it is because management did X, Y, and Z. Management intentionally did this. Management intentionally did this. Management intentionally distorted the numbers. But hey, you accountants, you didn't catch it. So whose fault is it? You're both at fault. But what courts will do now is do what's called contributory or comparative negligence. They will chop up the liability and say, okay, at the end of the day, we think 75% of what the problem was management's fault. 25% of it was the accountant's fault. Or some numbers, 50-50. Maybe there were some consultants in there. Maybe they're part of the problem too. So you get this spread of negligence. So you say there was a bunch of people in there. The fact that the numbers went wrong is not all the accountants. Yes, sir.
Now, the example that said where there was like 4 people that were involved in
Yeah.
high numbers, would that still come back on the accountants for not finding that? I mean,
It's all facts and circumstances, okay? There's no case that you can look at. Well, there's some that are rather obvious, okay? In this particular case, it was a very involved circumstance where the money that was being, it was a fraud. Where the money that was being stolen was not assets of the company per se. There were assets being stolen between 2 third parties, and the company was participating in siphoning off funds between these 2 parties. Trying to simplify this in 50,000 feet. when we went back and looked at it, we realized how the client had done this without anybody seeing it. We knew from reading the case that there's been a bunch of people, the auditors realized, hey, everybody we were dealing with, a lot of people we were dealing with all knew that. So anytime you went near something, they steered you somewhere else. And it was one of those things, without going into the details, where it was sort of not easy. It took a lot of Monday morning quarterbacking to come up with a way that it could have ever been done. Okay? It was a situation where we felt pretty good that the audit was a very good audit. You can always poke a hole somewhere. You know what? Listen, you're going to have the greatest pass defense in a football game, somebody beats you, and you're going to say, well, why didn't you have a guy here? And, it doesn't always work that way. Same thing with audit. You can sit there Monday morning and go, well, if you tried this test, but you look and go, I know what you're doing. I tried that test, okay? You look and go, I don't know what I'm doing that. But when you have collusion, you got a bunch of people working against you. It's hard to catch it, man. Everybody's steering you, one way or the other. That's not to say you'll win. In this particular case, we're pretty confident we've done a fairly good job. Not to say it wasn't perfect. There's no perfect thing. Don't come on the perfect. You can't ever be perfect. If you don't look at everything, you can't be perfect. There won't be perfect anyway. So then you get, again, once you get this, you get with the liability, what's called proportionate, joint, and several. And I don't know if you know what that means. Proportionate liability goes along with contributory negligence. You leaving?
I have a conference call.
Okay, you coming back? Okay. Proportionate liability. What that means is now, once the courts say, okay, it's 50% the accountant's fault, 50% the client's fault, the liability gets split. If it's $10 million, $10 million to you, $10 million to them. What joint and several liability means is you would do proportionate liability, but what if one side is bankrupt? Then it's joint or several, meaning, okay, you and I are 50-50, but you're bankrupt, I gotta pay 100%. Now, there's certain things in the accountant's liability, I think, that limit the amount of the joint liability that an accountant can suffer. I think it depends. I think they can only pick up, if I remember reading this, no more than 50% of the people who can pay. So if it was 75-25, the account was 25, and you're 75% of the client was bankrupt, the account could pick up, I think, up to 37.5% of that half of theirs. So they have 25 of their own and 37.5 of the other sides, and they'd be responsible then for 62.5% of the liability. So again, but it comes down to state laws in a lot of cases, how this is all done. So we're looking here at, again, possibly sharing liability in the case where, okay, the accountants were wrong, the client was wrong. Whose fault is it that the company went bad? Well, it can be contributory negligence. That was where the client came after you. But oftentimes the person who comes after you is not the client, it's the third party that's relying on your financial statements, okay? So now again, you've got a bank, you've got a creditor, you have an outside investor, third parties. Not the company that you audited, now the person who possibly put up money that has something to come after you for, a third party. Well, first of all, what happens what do they have to do to sue you? Well, one, let's start with, they gotta have lost something, okay? You give a financial statement to a bank. The client gives a financial statement to the bank determines it's a bad financial statement. The client's still paying the loan, the bank still has the collateral, the numbers are bad. But the bank's getting paid on its loan and its collateral back for loan. Can you sue you for the bad financial? Of course not. You don't lose anything. What's the law? You sue. What's the suit? For losses. You sue because you lost something. Yes.
I'm a little confused about third party beneficiaries and other third parties.
You have to show me from where you saw that. Third party beneficiaries?
Yes, these distinctions.
Where was it? I will look it up in the book because we're talking, mainly you're talking third parties. You're normally talking creditors, okay? Those are people who really, banks. A bank is a third party. Somebody you're not doing the financial statements for, but is relying on the financial statements for something, okay? That's what the concept is. Now, I don't know who in here they're referring to. When we get to it, and if I can find it, I will see. But let's try and concentrate the concept being, again, it's not the client suing you, it's somebody else who used the financial statement. Somebody bought a company, okay? They bought the company based on, I'm going to buy Carlos's company. I'm going to pay Carlos based upon how good his company is. So Carlos gives me a financial statement. I pay him based upon what I saw, and I find out later the financial statements are no good. This isn't nearly the company I thought I bought. The assets are overstated, the liabilities are understated, the profits overstated. Who do I sue? I sue Carlos for giving, for maybe me overpaying him. And maybe I'm going to sue Carlos's account. I'm a third party, okay? I'm a third party user. So again, we have the same breach of professional care is the main driver here that you can't do a good job. The fact of the matter is, if you can prove you did a job, a prudent professional audit under GS, you'll beat most lawsuits. You've done a good job, and you can show, hey, listen, this is what an auditor should do. And normally, how does an auditor prove that? Who do we hire to do that? Who would you hire? Who would you hire to do that? You wouldn't have to.
Here?
I get sued, okay? Because my audit was bad. I think my audit's good. Who would I probably want to hire as a witness for me? Who would be a good? What? No, we're not talking about crime. Okay, okay, you sue me for a bad job. I think I did a good job. I want to defend myself. I'm going to bring in a witness. I want to bring in somebody to testify on my idea that I did a good job. Who's most qualified to testify if my accounting firm did a good job? Exactly, another accounting firm. That's what you do. You hire a witness. You're going to hire a witness. You're going to testify a professional who's going to come in and say, listen, I work for a major firm. I looked at this firm's work papers. This is what I would have done. I think they did a professional job. They conformed to general accounting standards. They did what an accounting firm should do under these circumstances. And it's not their fault. They did a good job. The fact that they didn't see this, give me an example of something you can't catch. They talk about it in the book. Client gives you documents. They give you a contract. You read it. You say, it looks good. What happens if it's a complete fortune? What if it's a complete fake? They make up a document and give it to you. But is an accountant actually responsible for knowing that? Is that possible? Maybe. I think I told you the story. We did catch one client because they did a terrible job. I think I told you the telephones. The contracts were crooked with bad signatures. And I'll tell you what, I'm not sure if those had been typed on beautiful letterhead with legible signatures that looked good. How would I have known they were fakes? How? Would a prudent person expect an accountant to know they were fake documents? No. So again, you bring in professionals to help you, okay? So the typical case here, what is the typical case of a third party? They seek to establish and sustain the loss by relying on your misleading financial statements, which we included in an audit report that wasn't right. You said the financial statements were fair. They weren't fairly presented, okay? And as a result, this 30 party sustained the loss. I bought Carlos's company because I thought it was a good company making money, and I found out later it wasn't. Liability, of course, if you have gross negligence, okay? Always you get gross negligence, you got a terrible job, and nobody can defend, you're dead. Ordinary negligence depends on the jurisdiction you're in. Because we're going to look at different rules of third party, what third parties have to prove based upon jurisdiction. Meaning, and I can't tell you what states or what, I can talk about New Jersey, but different places in this country use different rules for establishing who third parties are and whether they're entitled to go after you. A third party can always go after you if you're really doing a miserable job. You're always dead there, okay? Three particular common law levels based upon case law. One of the most famous cases is what's called the Ultramares case. And eventually with the Ultramares case, and you can read it in the book, I'm not going to read you what happened here. I don't remember exactly. Ultramares, I think, was a creditor of a particular company. They went through money, and as I recall, Ultramares was a factor. In other words, they were buying receivables from a company. It wound up the financials were no good. They made a bunch of loans to a company that eventually went bankrupt. And the accountant was found to have committed ordinary negligence. The question becomes, under Ultramares, is whether or not you're responsible for this third party if you don't know that the third party is using the financial statements for the purpose that they are. It's called the known user approach. And under this, for a third party to sue you and to get away and to actually be able to win, the auditor has to know that the audited financial statements were used for a particular purpose by a known user. Meaning, if the client takes your financial statements, unbeknownst to you, and uses those financial statements to do something, and there's ultimately a loss, and you as the accountant didn't know that they were being used for that purpose, you are not liable. And that happens to be law here in New Jersey currently. What happened with Ultramares in New Jersey, and I think it was here in Jersey that it happened. I'm pretty sure it was Jersey, but I have to check that. This is pretty much the law in Jersey. We need to know who financial statements are going through. That's why we're very careful. Client calls up and says, listen, why don't you send my financial statements to the bank? We don't do that. We don't send financial statements to anybody other than clients. They can do with them as they want. Once we send things directly, we violate what's called privity, and we're not liable to people again. We don't ever directly send the financial statements in. If the bank wants a financial statement, we call the client and say, we're going to send your financial statement to you, you can do with it what you want. You can send it to the bank. We want to stay as far apart from third parties as we can. So this is called the Ultramares approach, the known user approach. You're only liable to who you know is getting the financial statements. The second approach is called the foreseen user approach. Let's read. The auditors knew the financial statements were used for a particular purpose, but the auditors did not necessarily know who the specific user was. Client says, I'm going to try and sell my car. I don't know what I'm going to sell. I'm going to go out, I'm going to find a buyer, I'm going to use the financial statements. You now know, it's called the 4C user. You don't know who, but you know why. So you should have, as an auditor, foreseen that people who are potential buyers are going to get the financial statement. If that's the law where you live, then you're susceptible in the event that those financial statements are no good. So Carlos calls me up, we're going to do an audit for his company. Carlos says, I need this audit to sell the company. Anybody potentially, now I now know if those financial statements are being sent to potential buyers, I don't know who the buyers are, but I foresee there's going to be buyers. I'm now susceptible to lawsuit by those buyers in the event that that audit went bad. The last is a little different, the foreseeable user approach. The auditor should have realized that it was reasonably foreseeable the financial statements would be used by the user. I've got a bank loan. I know there's a covenant in the bank loan that says they need financial statements. It's absolutely foreseeable that that's what they're going to be used for. I never said to me that's where I'm giving to the bank, but I'm smart. I know that's where they're going. And this was under a case called Rosenblum, and I don't remember. It's in the book. I think they describe these cases. So you've got different approaches here to third-party users. And depending on what state, what jurisdiction you live in, it makes a difference in terms of how, to some degree, you operate your accounting firm and your control over liability and who you're giving financial statements to. Like I said, this is the most liberal. This is the best one for accountants. If we don't know you're using it for a purpose, those people have no right to sue us. They come after you and you go, wait a minute, I never knew you were using it. Yeah, this would be a perfect example. I never said he was going to go out and sell his company. You never told me about this. You never told me you were giving financial statements to potential buyers. As long as I'm not grossly negligent, they can't really come after me. So again, it makes a difference where you are as to when third parties can sue you or not under ordinary negligence. You just did you did a bad job. Not that you did something so horrible that almost goes to Freud. Yes, sir.
So on the last one, you said that like you do the audit and you know that there are creditors based on your audit.
They would
know that they
I have a potential to sue you, yes. You couldn't say, hey, listen, I didn't know you were so, That makes sense. I knew the foreseeable. I have a client that gets about 500 copies of their financial statements. They don't borrow from the bank. Okay? They generate so much profit they don't need to borrow. But they have a lot of creditors that they get financial statements to at the end of the year. I think I would be susceptible to one thing. Cause the bank client doesn't. This comes under really when it goes to somebody you didn't even know was going to use it, okay? You had no clue that Carlos was selling his company as the auditor. No clue. Never called you, never told you. The next thing you know, somebody's suing you. What are you doing with the financial statement? Oh, I'm buying Carlos's company. I'm suing because numbers are bad. It doesn't fly. So again, let's report the Ultramares case. This was based on this case, Ultramares versus Touche, dating back to 1931. The landmark case of the common law that established that auditors don't be held liable to third parties for ordinary negligence and to other third parties for gross negligence. And again, it was affirmed here. The auditors must demonstrate knowledge of reliance on the financial statements by a third party for a particular purpose to be held liable. In other words, you had to know they were lying. This again always comes back to, hey, listen, you can't just sue the accountants because the numbers were bad. Did you rely on them for something, okay? You can't at the end of the day say, listen, I lent this company money. Why? Well, I wouldn't, in the ordinary course of business, they're accounting money. I gave them credit. I asked for the financial statements at the end of the year, but I've been giving them credit for 20 years, okay? All of a sudden, somebody wrong, well, let me go look at the financial statements. Oh, did you rely on those financial statements to give them credit? No. You're not going to sue the accountants. You didn't use the financial statement for that purpose. How can you blame them for the losses? So again, what is the key to this Ultramares? Auditors must be aware that the financial statements for be used for a particular purpose by a known third party to be liable for ordinary negligence. You have to know who the third party is who's getting the financial statements. If you don't, you're not liable if you're in a state that uses the Ultramares case. On this case here, which is a 1986 case, which is what's called the Restatement case, in this case, to be held liable for negligence, the auditors must be aware that financial statements will be used for a purpose, although the identity of the third party need not be known. This is again, I give Carlos statements. I know he's selling the company. I have no idea who he's going to give them to. But if he's giving it to potential buyers, I'm liable to him. And the last one, really the Rosenblum, this thing here, it leaves you open to liability of virtually anybody relying on your financial statements. You should have foreseen they were going to use it for credit. You should have foreseen they were going to use it for this. And it was a foreseeable event. I know my client is getting borrowing money. I should know that. I know they're going to give financial statements. I'm liable to those third parties in the event something goes wrong. So this is just, again, repeating again, third party. The third party liability is it's broken down into its three components. Let's talk a little bit about statutory law now. This is different. Now we're talking about public companies for the most part, and liability under the Securities and Exchange Acts. The first one was in 1933, 33 Exchange Act. It was the first one. What the 33 Act deals with is initial public offering of securities. Selling companies, let's make a clear distinction. Companies selling securities into the market. Not the trading of securities later on. You go into the stock market and you're buying stock today, and you're buying already established companies. That's covered under the 1934 Exchange Act. When you're buying stock that a company's issuing directly now, right from the company, going public, an IPO, or I'm issuing some more new securities on it, and I'm filing what's called an S1 registration statement with the SEC. That's covered under the 1933 Act. So what do you got to prove again? You're the third party, you're the investor, you got a loss. One, you got to prove a loss. You got to prove that the financial statements were misleading. But this is an interesting thing in the 33 Act. You don't have to prove. You have no reason to have to prove that was why you lost money. You don't have to prove you read them. You don't have to prove you looked at them. All you got to do is say, the stock went down, I lost money, the financial statements are no good. You're done as the plaintiff. You're done as the plaintiff here. Did you rely on the financial statements? No. You say, well, then why shoot the accountants? 33 Act doesn't say that. What the 33 Act said was, at that point in time, the burden of proof was on the accountants to prove they didn't screw up. It was the accountants now. It was the defense's job to prove they did a good job. But the interesting thing in this, which sounds a little screwy, is you didn't have to rely on the financial statements. You would think, well, gosh, if they never read the financial statements, how can it be the accountant's fault that I lost money? That's not what the 33 Act says. It says, did you lose? Yep. The financial statement's wrong? Misleading? Yep. Now it's the accountant's responsibility to prove it's on his fault. Because if he doesn't, it's on him. So at this point in time, it's basic standard of liability, where normally you have to prove something that the accountant screwed up. No. This time the auditor must prove he did the job right, that he had to do it. And if he can't, he's held liable. Even though you as the investor, never even look at the financial statements. 34 Act different. The 34 Act doesn't deal with the sale of securities from the company to the investor. The 34 Act deals with now you're trading securities, okay? You're going into the stock market, you're buying a stock. Hypothetically, you buy Bank of America or you buy Exxon or some other publicly held company. and you have a loss. All of a sudden you find out, hey, the financial statements weren't any good. Is it a little different? Yeah. One, you have to have loss, sue. Two, the financial statements have to be bad, they have to be misleading. But here the burden of proof, you have to A, show that you relied on the financial statements. And the third party must prove the existence of something, I can't pronounce this word. Can anybody pronounce this? Santa? Anybody try? I can't pronounce it. You have to be able to prove the auditor's intent to deceive, manipulate, or defraud. Did the auditor intend to do that? So it's completely different between the 33 Act and the 34 Act.
So I have a question.
Go on.
When we're mentioning, you said that those acts cover when people don't know. That's the one that you said, the first act covers only people if they tell you they're going to give it to like the bank. But if they don't
Wait, no. We're backwards. Slide to that.
Slide before.
Okay.
The first act that says that.
The Ultramares case.
Yeah.
Under Ultramares, right.
So what about publicly traded companies that their financial statements are issued through the SEC? Everybody knows.
Financial statements now that are issued to public companies are governed by statutory laws. They're covered under these laws.
So now they don't get covered under that.
That wouldn't be covered under common law, to the best of my knowledge. Public companies get covered under the laws that are statutory. The others are case laws. These are statutory laws created by our government. These are federal laws. This would govern your liability. The 33 Act covers you're coming out with a stock. You file an S1 registration statement. That stock comes out, people buy it, and 6 months later, the thing's down the toilet. Okay? You say, you look into the financial statement. You don't even have to look at the financial statement. Where you have someone looking, go, they're wrong. Okay? So when you look at the 33, it was an initial public offering. You bought it at $1. It's now 2 cents. You go back and find out that the financial statements were misrepresented. Okay? So A, do you have a loss? B, were there misleading financial statements? Yes. Mr. Gomez, did you read the financial statements? No. Did you rely on the financial statements? Nope. Does it matter? Nope. Doesn't make any difference. You didn't rely on them? Doesn't make a difference under that law. At that point in time, it's the accountant's job under the 33 Act to prove they did a good job. They didn't do a good job, doesn't matter whether you read it or not. They're liable for it. 34 Act's totally different. And it doesn't cover the same type of securities. It covers that same stock 5 years later, and it's trading, and you buy it at $1 and it falls for 2 cents, and you go back and you go, well, where are the financial statements? And you find out they're misleading. At this point in time, it's a completely different set of rules, and now you got to prove that the auditor to deceive, manipulate, or defraud you. Okay? This is a case again. This was under the 33 Act. This was one of the first cases where the auditors lost you. The auditors want to establish that they did due diligence with respect to what's called an S1 review. What an S1 review is, the client comes out. What the auditor is required to do is, you've got financial statements. They're going to be filed with the SEC, okay? And SEC takes time to review them. After everything's approved and everything's accepted, you're then allowed to sell your security. But there's a time gap in there. The auditors are required to review transactions that are during the date between the S1 being filed and the stock comes out. The auditor has a responsibility to make sure nothing happened in that period of time that could have caused there to be a problem with the company. In this case, that's what happened. They were able to show that the auditors didn't do their job in between. Their questions were bad. They were misled by management. They didn't do a proper review under the rules, and as a result, they didn't do the proper due diligence that's required under GAS and under SEC guidelines. Again, the burden of proof here was not on the client. The people who lost to prove that the auditor did a good job. The burden of proof was on the auditor to prove they did a good job, and they weren't able to. As a result, they were held liable in this case. I don't know what the damages were. 34 Act, this goes differently. This is a case where the Supreme Court concluded that they couldn't prove that the auditor's knowledge of a fraud. But you've got to prove that the auditor knew about a fraud. Remember, the auditor in this case, I don't know all the details of the case, but again, Ernst & Ernst won this case. It was a case of, again, what did you have to do under the 34 Act? You've got to prove that the accounting firm intentionally did things wrong, intentionally deceived you. In this case, the Supreme Court the auditors didn't have knowledge, that they couldn't prove that the auditors did. Now, there was another law passed in 1995 called the Private Securities Litigation Reform Act. What it did was put limits on auditors' liability. Again, we went to proportionate liability under this law. So again, the accountant got stuck. He audited a company that went bankrupt. He determined the management of the bankrupt company was partially responsible for all this. So they assigned proportionate liability. What could you do when one of the people who's partly responsible parties for what happened no longer has any money? Does the accountant have to pay for all this? What this did was limited to what I said before. I forget what the definition of a small investor. What they did in this case is said, listen, to the little guys out there who don't have the ability to really analyze things, rely on auditors, we're going to make the auditors make them whole. But the people who are not called what was defined as a small investor, they said auditors are limited to an amount of 50% of the auditor's proportionate share of the losses. So you were not to exceed of the proportionate share. So again, the auditor was assigned a certain percentage and couldn't pay more than 50% of the other side's responsibility if they didn't have the money to pay. This was, again, kept the auditors from getting too slaughtered out there in the cases when, again, something went wrong, the other side couldn't pay this. Oh, RICO, again, this was put in there, it's a racketeering law, okay? And what it did was allow up to triple damages in the case of, again, something went wrong. It wasn't designed originally to get CPAs, but again, if an accountant knew or should have known of material misstatements of financial statements, they could get dragged in under certain provisions of this act. And what happened in 1993 in the case against Ernst & Young, they decided accountants couldn't be held liable under RICO unless they participated actually in running the company or management of the operations. They sort of got the accountants out from underneath this thing. It sort of dragged us into things we really didn't belong being in. It's racketeering.
Is that a criminal statute?
Yeah. But it also has, it has financial implications to both, yes. Can we be held liable with criminal liability? Back in this case in '69, if you read the details of the case, what happened here is a company lent money to another company, and the financial statement of the company that did the loan, the auditor said the loan was fine, it had collateral, and they left it on the books as a receivable. Unfortunately, the company lent the money to had taken that money, lent it out to the president of the company, who lost it. He couldn't pay it back to the company he borrowed from, and as a result, the whole loan went bad. The auditors hadn't uncovered any of this stuff and hadn't disclosed any of this stuff. What happened in this case is it was a public company. Two partners and a manager were convicted of filing false statements to the government. Mail fraud and other violations of the Security Act. They were found guilty of not disclosing related party transactions, which actually resulted in a new gap in terms of disclosure of related party transactions. And if you read the book, these guys went to jail and were eventually pardoned by the President of the United States. So yeah, you can be held criminally liable in some cases. Arthur Anderson was held criminally liable in the Enron case. You follow Enron and you were too young to do that. Yeah, it was a bad one. Yeah, there was independence issues that were tough. and we've talked about them. Yeah, Enron was doing all kinds of things to inflate income, to create transactions purely for accounting purposes. I mean, there was enough there to, really get an accounting from for a variety of things. But eventually, why were they found criminally liable? Well, one, there was a memo that was found in the files in which a partner in a law firm advised the partner on the job to omit certain information from the financial statements, and also it included a comment that an Enron press release, right in the innocent papers, included earnings in that that was misleading. In other words, Anderson was aware, and had something in the work papers indicating that they knew the numbers that were being issued to the public were wrong. Plus, the worst part of the whole thing, if you go back and read, was the fact that prior to them being indicted and brought in, Anderson did a massive shredding of work papers. I mean, that to this day is the first thing, like I said, we tell our people. You can't destroy anything. You can't touch anything. There was, massive. And what the Anderson people said, they were only complying with the firm's policy on work paper destruction. In other words, we don't have to keep work papers forever. We only keep them as long as the statute of limitations require them to be kept. And afterwards, we get rid of them. I mean, back in the days of paper, when we did paper audits, we had so much off-site underground storage. We kept papers for years in underground storage facilities because you kept papers forever, and then you realize you shouldn't and don't want to. Hey, it's expensive. So you only maintain work papers, according to firm policies and statutory limitations. In this case, they decided that they didn't need to keep certain papers. So after they got hit with this, they started shredding papers. Well, that certainly didn't sit well with the jury either. Eventually, this conviction was overturned by the Supreme Court, but not for reasons that there was something wrong with the verdict. The only problem was that that I think they said that the instructions given to the jury were incorrect. And here in this country, little things like that can cause a verdict to be overturned. Was the case ever retried? No. There was no reason to. Anderson was gone. There was just nothing left to go after. There was no employees, no partners. Assets were gone. The company, the largest accounting firm in the world, had disappeared off the face of the planet. But yeah, they were held criminally liable in the Enron case. What are the powers of the SEC? What can they do to you?
Sanction you.
Well, yeah, they can sanction you. Can they stop you from working in the public arena? Yep, absolutely. Can they take punitive action against you? Yep. They can put penalties and restrictions on you. A number of years ago, not that many, within the last 5 or 6 as I recall, CPA, I can't quite remember, stopped one of the big 4 accounting firms. They put them on a 6-month restriction. They couldn't take new SEC clients. So if a public company wanted an auditor during the 6-month period, this firm was precluded from taking any new clients. Is that significant? Yes. Yeah, that's a significant penalty. That for 6 months they couldn't go after new accounts, which again, these are big accounts. What else can they do? They can force auditors now to report illegal acts by the clients if the auditor doesn't. So you're auditing your client, you find out they're doing something wrong, you require them. You are required under SEC regulations now. You tell your client, you call the SEC, I think you're given 1 day. If you don't call the SEC, we have to call the SEC. If you don't do that, the client doesn't do it, and you don't do it, then you're subject to whatever sanctions and things the SEC does to the company, they can do to you as an auditor today. The PCAOB, yes, sir.
Would that be you as the individual auditor, or would that be
The firm?
How would that like you as the individual, like you're one of the staff?
When they go after staff, usually not. Usually they don't go after people below partner. They've gone after managers, I've seen. They could go after staff, I guess. I've seen cases, I think. I've seen things where they've gone after the people under management. But are they going to go after new staff? No, not normally. They're not going to go after people like that. They want to go after the responsible parties. They go after the firm and the significant partners that are in charge of these things more than they go after the people who are just working under direction. It's ultimately the partner's responsibility for all this. Partners get paid a lot of money, but they have to take responsibility. It's like it's like the manager of a baseball team. At the end of the day, you're in charge. If your auditors do a bad job, your staff does a bad job, the quality controls are in place within a firm so that if a staff does something wrong, the people above them are reviewing the papers. You as a manager are reviewing papers. And then ultimately as a partner, you're signing off that you looked at things, okay? Maybe not in the same detail, but ultimately it's your signature at the end of the day that matters, okay? The PCAOB, they come into all firms that do public work. They come in and visit resident on a regular basis. What can they do to you if they put disciplinary actions? Can they do it on employees too? Sure, if they find that they can put disciplinary actions. They could say things like certain employees can't work in public companies anymore. They can put that restriction on. They can come to a firm and say, listen, we've looked at a bunch of jobs. We've looked at Michael Cohen's jobs. We are completely dissatisfied with his work. The sanction is for the next year or two with Michael Cohen has to get the following continual professional education. We need him to take a bunch of courses, and for the next year or two, he's not allowed to run public jobs. They can do that. They can do that to staff too if they fail. So they can come in here, monetary damages, suspension of firms and accountants from engagement for publicly traded companies. If they really thought you were bad as a firm, PCAOB comes in and pulls 10 jobs and they all stink. They could theoretically say, okay, your firm is no longer allowed for a period of time, not allowed to do public work. You've got to call the public clients and say, I can't do your work anymore. I've just been knocked out by the PCAOB. And maybe you're going to be allowed back in a year, and you have to go through a certain educational process. But think about what that happened in a year. Your public clients will have to file financial statements. They're not hanging around waiting for you. A year later, you may be back in business with public companies, but you lost everyone that you had. You all had to go get new auditors. And if you really got something bad, they can refer something to the Justice Department. I haven't seen that. I assume it happens. But I haven't heard about anything or seen it. Do we have responsibility for financial statements when they're not audited? I say they're not audited. When we do less than an audit, when we do a review or a compilation. We have talked about that. Do you know what reviews and compilations are? Here's where you do. I mean, a review is, again, when we come in and do analytical procedures, it's less than an audit. Send out confirmations, we're not sending out legal letters. We review, we look at financial statements, we do analytical tests, we check gross margins, we look at accounts, we look at backup, but we're not doing an audit. So we're giving what's called limited assurance. It's less than an audit. The lowest level of what we can do with the financial statements is called compilation. We give no assurance. Financial statement, we get numbers from clients, and if you want the literal translation, we take the financial statements from a client, we look at them, we say we don't see anything wrong with them, they look okay, we type them, we put a non-opinion on the front that says we compile them, there's no assurance, this is all we did, and out they go. Do we have liability when we do these things? Yeah, we do. We do. There's been cases on these. One, again, you've got to be sure in your engagement letter with your client that you were specific what you were going to do and what you weren't going to do. So you do a compilation, you got to tell your client it's not compilation. There's a case in here they talk about where the client, they didn't have an engagement letter, they had an oral agreement to do all the client's accounting services. The client believed that included an audit, which it didn't, but there was no engagement letter that proved what the client's services actually were. Now, what if you go out, you do a whole bunch of work, you send confirmations, you do verifications, you do all these calculations, you send the bank, you do the bank recs, you send confirmation letters to your clients and the clients. Why do you do all the work that makes it look like an audit? Can you then hide behind a review and say, I did a review? Can you do that? No. We're very careful, accounting firms, to do what we're hired to do. We don't do more because you can't hide behind, in effect, saying, I'm providing limited assurance when you did the work to provide assurance. You can't sort of downgrade you gotta be careful if you're doing a review to do a review, not to do an audit, or not to do something that makes it seem like an audit. Because once they pull your papers, you say, well, listen, I'm only providing limited assurance, I only did a review. They pull your papers and say, wait a minute, you did everything that an auditor would do to verify accounts receivable. You did all this, you did this, these are audit procedures. Yeah, receivables are wrong. So you can't hide behind the wrong opinion or the wrong assurance. You have to say what you did and do what you say you're going to do. So there was this case again. It was the same that what I was talking about. Didn't have an engagement letter to the client. So there was definitely a misunderstanding between the client and the accountant, what the services that were to be provided were. As a result, what the client expected and thought the accountant was doing was a lot more than what the accountant actually did. And when things went wrong, the client said, hey, listen, you said you were going to do all this stuff. Now things went wrong, I'm suing you for it. The client wound up winning. So again, this slide says again, engagement letters, mandatory in all jobs now. I know every firm does that. You're always, again, no matter what level of service, you've got your nose up, you're always skeptical. Something's wrong, something doesn't seem right. You have a professional responsibility to investigate it. You see an unusual item, you ask for some invoices that can't be found. You as an accountant have responsibilities no matter what level of service to ask questions. And this is all guide. You'll see this if you were to read SARS, it's the guidelines for doing reviews and compilations. You've got to use the right language, and you've got to always investigate things you don't find right. Otherwise, you can be held negligent. So really, we're sort of done with this chapter. This is just a summary of the laws. I don't need to read them to you. And you got to know the difference about when the plaintiff's the client or a third party. You should understand the difference of the Security Acts, what the proof of birth, where the proof is, who needs to prove what accountant's responsibilities are. Basically everything I just covered in the last hour and 40 minutes or so.
Can you slide where you can see the difference?
The one I just had up? Okay. I just want to talk about how we prevent litigation. This.
See, the second line of the line is third party beneficiary, and the last line is other preferred.
I don't know what that means. I don't know what that means. I tell you when you do something. I don't know who the third parties are. I don't know. Sometimes it's such a weird. I don't know who the third party is. Third parties are third parties, other than clients who can sue you. The client can sue you, or somebody else can give the financial statement, right? That's the third parties. I don't know who other third parties are, so I can't answer that. But I want to ask you a question now. I'm going to ask you a question. So what do we do to prevent litigation? What do accounting firms do? You can listen to all this and say, listen, I'm going to get sued at some point in time. And I'm going to tell you this. There's not an accounting firm out there that's probably of any size that hasn't gotten sued at some point in time. They all do. Okay? Everybody gets sued at some point in time, whether it's frivolous or not, it happens, okay? Somebody's not going to be happy, okay? So what do we do as a firm to keep it to a minimum? How do we protect ourselves from something we know and not see what's coming, okay? We know it's going to happen. Tremendous compliance on gas and professional ethics. We are continuing within our firm. We give a lot of continuing professional education. We are continually improving our audit techniques. We are continually monitoring our own products, looking at our work papers, looking for better ways to do things, trying to improve audit performance and make sure our checklists and everything we do conforms with professional requirements and conforms with GAS. In most cases, what this means is we become more and more standardized accountants. If you go to work for any of the big four, you go to work for any major firm, you're going to find that most things become extremely standardized accountants. We don't allow for tremendous creativity in audit. Yeah, you got to be smart when you audit and come up with ideas and thoughts of new ways or things as you look at them and say, well, I got to look at this logically. But we don't look for creativity. We're looking for, to be honest with you, as much standardization as possible. You continue to do the audits in accordance with certain rules. You're going to do them properly. You're going to conform with firm policies, and you're going to conform with GAS. So that's the first thing. Incredible emphasis on compliance. Accounting firms have lawyers on staff. You bet your life we do. I can't even imagine how many attorneys work for the firm. We have a couple full-time attorneys in our firm. We might have 3. I think there's one in another office. I saw one. There's 2 in our offices. There's 2 by Tom's office. We have 2, and I think we have 3 in our firm. You say, why do you need them? You get sued so much? No. You need them because you want to constantly be bouncing things off of them with problems. Who do I go talk to when I have an issue? Talking to a client, and we're getting into a little problem with the client. We're not getting along. And the client finally says, you know what? No, you don't get this done. I'm getting really pissed off. I'm going to sue you if there's a problem here. He said, you know what? I'm trying to sell my company, and you keep busting my chops. You don't have enough documentation. You're not happy with this. You want more documentation. You're not sure you understand this transaction. I got a buyer waiting for the financial statements, Cohen. I need the financials. I want them tomorrow. Well, I'm sorry, Mr. Client, but I'm not quite ready to get them out yet. We still don't have our legal letters back. I promised the buyer the financial statements by tomorrow. He doesn't have them by tomorrow. He's walking away. And if he walks, I'm suing you. Well, what do I do? I got a problem. That's why you have attorneys. When you get that situation, I get up from my desk, I walk right downstairs to counsel and go, we have an issue. Client threatened to sue us. What do we do? And everybody say, what do you do? Usually you've got an issue there where you've now got an independence problem. Because what happens if I get afraid and I issue the financial statements tomorrow and they go bad? Okay? Okay. You buckle under to the client because you lost your independence. You're afraid of losing your fee. You're afraid of getting sued. Yeah. Normally we don't put dates on. We're going to issue fine. Now, could there be a date? Sure. Let's say again. We've got the situation. He's the client. He's got this big deal out there, okay? And his buyer says, I want financial statements by Friday. I'm sick of waiting. I can't get financial statements out because I can't get his lawyer to issue the legal letters. And I can't get them out because I can't get my accounts receivable confirmations back. He couldn't care less. Why don't he doesn't care? He wants those financial statements in the buyer's hands because he's got this big deal. And what is he thinking? It's my fault. Get the report out, Cohen, okay? I need it out. I want to hear about the problems with the accounts receivable confirmations. And you know what? The deal blows because you didn't get your audit out on time. I'm blaming you and I'm suing you. The point being here, when that happens, we're down in the legal office, okay? We're down What happens when the client hasn't paid his bill? And he's now watched this year's audit. We'll pay our money today, Michael. I'll get to you next month. But I need the audit started. We can't start audits. We have rules. And we start getting in a fight. Down to legal. How do we get paid? So what I'm saying is legal counsel who understands accountant's liability. Okay? What happens when we get sued? What do you think? Legal counsel in our firm. What do you think is alerting everybody in our firm? We've got a problem if there is one. Grabbing all the auditors who are on the job and saying, okay, we just had a problem. Lock down your work papers, lock down your emails. Somebody's got to maintain, control that. Well, who's legal counsel that understands that? Smaller firms have it enough. Would they have lawyers? Will they have lawyers on call, on retainers for that? Yeah. Are there lawyers whose entire career specialization is CPA liability? Absolutely. There's a whole bunch of them. You can be a criminal lawyer. You can be a corporate lawyer. You can specialize in accounting liability. And there's a whole career there for you. Liability insurance. Boy, is this key. This is key. How much? Not only is it key that you need to have it and it's expensive, the question always comes, how much do you need? How do you determine what the right amount is? Sometimes the rule of thumb is when people sue you, the first question they ask you is how much insurance you have. They do. How much can we get at these guys, okay? $10 million, maybe all you get. So professional liability insurance is based upon a couple of factors. One, how risky are your clients, okay? And how big the firm is, okay? As our firm has grown, when we have more and more people, more and more accounts, we've obviously upped the amount of insurance that we've had. But a lot of it depends on the type of business you're in. If you look and you have a large business, but you don't have a high-risk business, say, well, you have a big practice, but all you have is a lot of personal income tax returns, is your accounting practice, you're not going to be as worried about large lawsuits as you are as like the Big Four is. Because as you look at them, their clients are gigantic. Any one problem can be catastrophic to a firm of that size. So the amount of professional liability the insurance they need to carry is, they're big numbers. Investigate prospective clients thoroughly. Like I said, we do background checks on our clients before we take them. You don't want risks. At least know who you're getting in bed with, so to speak. Know your clients before you take them on. As I think I've told you before, I get client calls on the phone. We want to hire J.H. Cohen or Cohen Restatement. Like, I'm not over the telephone. You're not doing that. We're very happy you want to hire us. We need to do a background check. Sorry, that's part of our firm requirements. And we need to meet you and ask a few questions before. So again, you got to know who you're getting in bed with as clients. Say you're from litigation. What happens if you find out your prospective client sued you as 3 accountants?
Forget it.
Exactly. Okay.
We don't need any trigger happy.
I had a client I used to get a fight with fees. Okay. He said, my last 5 accountants always told me I didn't pay them enough. That's not true. My last 5 accountants always complained that I didn't pay them enough money. I sort of scratched my head and sort of was trying to wonder which one of us is wrong in this conversation. If I'm the 6th accountant we've had in 7 years who complains about their accounting fees, okay? We're all dopes, or maybe you're just cheap. So you got to know who you're dealing with. And before you do any audit, understand the business. This causes a lot of bad audits, believe it or not. Auditors who don't understand the client's business and what they're really looking for. Because some businesses are easy, some businesses are simple. Other ones, not so easy. You got to get a thorough knowledge. The first thing we always tell our auditors, learn the business, learn the nuances of the accounting, learn what to expect in this type of an industry. You go in, once you know the business, you sort of know where to look, okay? You can't just go in and somebody say, go audit receivables. Well, receivables in one company, you might say, oh, auditing receivables. Another company that you pay 30 days, or they come in 30 days and something. We used to audit this company that was in the nursing home business, home health care and nursing homes all over the place. The receivables were Medicare, Medicaid, insurance companies, tremendous reserves on receivables, receivables that sometimes took 12, 18, 24 months to collect. You talk about an audit that's ugly. Trying to audit something like that with a receivable you may not get for another year, 18 months, you don't know what you're going to get. So just being able to say, well, I'm going out to audit accounts receivable, one set of receivables is not the same as the next set of receivables. One inventory is easy to audit, the next one's not. But knowing the client's business and understanding what they do is key to being a good auditor. Engagement letters, every job. Never have a misunderstanding with the client about what services, what they're expected to do, what you're expected to do, what you're going to charge. If you want an issue you're going to have with a client, do not spell out clearly in your engagement letter what your fees are and what they're based on. Are they based on standard hourly rates? Are they based on fixed fee? When are they payable? Are expenses included? There's a key one. Are expenses in on or are they not? Do we get out of pocket? Our client's out of town and find 5 auditors somewhere for 5 weeks, in and out, staying in hotels, feeding them every day, rental cars. That adds up. Is it covered in the engagement letter? If it's not, and the client said, I never told you I paid for expenses. You look at the engagement letter, it doesn't say it. How are you going to charge for it? So the engagement letters, like I said, they're like this these days. Assessment of internal control and assessing the risk of errors and irregularities. Again, going in with your eyes wide open saves you every time. Understand what you're up against. Understand the client. Understand the quality of the accounting personnel you're dealing with. Do I have a sharp controller? Do I have a sharp accounting staff? Do I have adequate accounting staff? Or somebody, the bookkeepers doing payables, receivables, general ledger, and the financial statements, along with doing credit checks and who knows what. So assessing the people is always it's part of our planning meeting. We always talk about the people. We have journal entries here, or the books and records clean? Do they give you a full set of work papers? Or when you get in there, you're scratching and clawing every day for work because, the client's not ready yet. He's going to have it for you tomorrow. So you look at this. When you get situations like that, risk of errors, irregularities go way up. You got to be aware of that stuff. You see a client's losing money. Should your expenses be up? There could be problems. Is your risk gone up? Absolutely. You got to look at business risk. When you look at a client and you go, well, you got to get almost inside the client's head sometimes. Client can know the company, the people who work in the financial area. How much risk is there? What's the status of the business now? The worse the client's doing, the more business risk they have, the more audit risk you have. Bad situations cause people to do bad things, okay? When the business risks, so again, business risk causes audit risk. And lastly, carefully and prepare and review working papers. This is what they come in for. Lawsuit happens, lock down your work papers. That's what they're looking for. The lawyers come in. Like before I said, we hire a captain. What happens in the lawsuit? Here's what happens. The client sues us. We get an accounting firm that says we did a great job. We even pay their accounting firm that says we did a less job. Okay? So you want your work papers to stand, you want to know that they were prepared properly, and most importantly, they were reviewed. There's got to be documentation. Not only did the staff person prepare them, but the right people reviewed them, and ultimately the partner signed off on them. And that the hours in the system document that you did the work. You don't have a stack of work papers this big, and your HR records say you spent 10 hours on it.